All right, let's get right to it. DoorDash. They just dropped what some are calling a bombshell quarter. The stock, as you'd expect, is all over the place. You've got headlines screaming about explosive growth, and investors are trying to figure out one simple thing. Is this the generational buying opportunity everyone's been waiting for, or is the market about to pull the rug out from under them? Today, we're going to put this company through the ringer and find out exactly what it's made of.
Welcome to Iron Financial. I'm your lead analyst. Our mission here? Well, it's simple. We don't ride hype trains, we don't chase momentum, we build portfolios out of steel. What we do is take the market's biggest stories, the ones everyone is talking about, and we strip them down to the studs. We stress test the foundation to see if it can handle the weight. And today, we are turning our full attention to a titan of the gig economy, DoorDash. They've just reported their fourth quarter 2025 earnings, and I gotta say, on the surface, the numbers look absolutely colossal.
That's right, and I'm the market skeptic. You know, it's my job to look at a structure like that and ask the tough questions. The numbers look good, maybe a little too good. We've all seen plenty of companies put up incredible growth numbers by just lighting piles of cash on fire and making big promises about the future. So I'm here to ask, is this a fortress of real, sustainable profitability, or is it just a beautiful facade built on shaky ground? We're going to drill down past the shiny headlines, get our hands dirty, and inspect the raw materials. Is this empire truly built to last, or is it a house of cards just waiting for a strong gust of wind? Let's get to work. Okay, let's do it. Before we can apply any real stress test, we have to understand what we're looking at. We have to build the bull case. And let me tell you, the materials DoorDash has given us in this Q4 report, they are heavy duty. We're talking thick gauge steel. Management didn't just meet expectations, they blew right past them. So let's start by looking at the core pillars that are holding this entire bull case up right now. First things first, we have to start with the sheer scale of this operation. The big one, Marketplace gross order volume, what the industry calls GOV. Now, this is the total dollar value of every single order, every burger, every grocery run placed on their platform. In just the fourth quarter, that number surged an incredible 39% year over year. Think about that, 39%. And it hit nearly $30 billion. Let that number sink in for a second. $30 billion in 3 months. This isn't some small startup growing off a tiny base. This is a massive number that is absolutely exploding. This is the engine of the entire business, and right now it is running white hot. And here's the critical connection. That massive growth in order volume is translating directly into the company's pocketbook. Revenue is up 38% year over year. That's $4 billion for the quarter. Now, the synchronization here is absolutely crucial. A 39% jump in GOV and a 38% jump in revenue tells you that the growth isn't being given away. It's not being bought with a ton of unsustainable discounts. It's being captured effectively on the top line. This is a foundational steel beam in the bull case structure. It is proof positive that their business model can and does scale with demand. But here it is. This is the punch that really lands for the bulls. GAAP net income. And listen, we're not talking about some adjusted pro forma fantasy number that companies like to invent. We are talking about real bottom line profit, the kind you can actually take to the bank. And it's up a staggering 51% year over year. You have to remember, for years, and I mean years, the entire story around DoorDash and its competitors was growth at all costs. It was a relentless burn of cash just to acquire customers. This number, this 51% growth in real profit, signals a fundamental tectonic shift. This isn't just growth anymore. This is disciplined, profitable growth. In this chart right here, this shows you exactly what that looks like in plain terms. On the left, Q4 of 2024, they posted a solid $141 million in net income. Pretty good. Now, look to the right. Just 1 year later, that number jumps to $213 million. See, this isn't a small step into the black. It is a long, confident stride. It demonstrates real leverage in the business model. It proves that as they get bigger, each dollar of revenue they bring in is actually becoming more profitable. This is the visual proof that the machine is not only running, it's becoming more and more efficient with every turn. So the big question is, how are they doing this? How are they achieving this kind of profitability? Well, it all comes back to one thing, orders. Let's look at the quarterly trend for total orders. Back in Q4 of 2024, they did 685 million orders. Now watch what happens as we move through 2025. 732 million, 761 million, 776 million. You see that? Nice, steady growth. Then look at Q4 2025. A massive, jaw-dropping leap to 903 million orders. But the most important column here is on the far right. Look at that year-over-year growth rate. It was humming along around 18 to 21%,
and then all of a sudden it jumps to 32%. In a business this large, growth rates are supposed to slow down. It's the law of large numbers. They're supposed to get weaker, not accelerate like this. This is a massive bullish signal. Something big happened here.
And that something big has a name: Deliveroo. On October 2nd, right at the start of a fourth quarter, DoorDash closed their massive acquisition of the UK-based delivery giant, and you can see the impact immediately. It's like they strapped a rocket booster to that total order growth rate. But here is the really critical piece for the bull case, so listen close. Even if you completely remove Deliveroo from the equation, if you just look at the core business, total orders still grew a very, very strong 20% year over year. So think about what they pulled off. They made a huge, accretive acquisition that is already adding over $45 million to their adjusted EBITDA in its very first quarter, and the core organic business underneath it all is still firing on all cylinders. This is a story of both smart acquisition and powerful execution.
All right, I'll give you that. It's a very compelling story. A fortress of growth. It sounds practically impenetrable when you lay it out like that. But here's the thing about fortresses. Every single one has a weak point, a vulnerability, and it's my job to find it. So now that we've seen the beautiful glossy blueprint from the bulls, it's time to apply the stress test. Let's start tapping on the walls and see if we can find some cracks in this armor. Because as impressive as all those backward-looking numbers are, remember, the market invests in the future, not the past. Exactly. I'm not here to debate that Q4 was a blockbuster. It was. The past looks fantastic. But what about the road ahead? You see, a company's true strength isn't just found in the quarter it just delivered, but in the guidance it provides for the one that's coming. This is where we separate the solid steel from the cheap hype. So let's take a hard look at management's own forecast for the first quarter of 2026. And boom, here it is. This, to me, is the first potential stress fracture. Take a look at the guidance for Q1 2026. On the top line, Marketplace GOV is guided to be between $31 and $31.8 billion. Okay, that's up from the $29.7 billion they just did, so that looks fine, no major alarm bells there. But now, look at adjusted EBITDA. They just delivered an incredible $780 million. So what's their guidance for the very next quarter? A range of $675 million to $775 million? Let me get this straight. Even at the absolute high end of their own guidance, they are forecasting a sequential decline in profitability. After painting this beautiful picture of accelerating growth and operating leverage, why are they suddenly telling us to expect them to make less money? And to their credit, they don't try to hide it. It's right there in the press release. They come right out and tell you why things are about to slow down. Our current expectation for adjusted EBITDA in Q1 2026 is impacted by three primary factors. Now, let me tell you, whenever a company starts listing out factors and headwinds right after a great quarter, you need to lean in and pay very close attention. These aren't just excuses. They're an admission that new costs and new challenges are entering the equation. So let's break down these factors they're citing. First up, that shiny new acquisition, Deliveroo, the one that looks so great. Its contribution to adjusted EBITDA is guided to drop from over $45 million in Q4, all the way down to less than $25 million in Q1. That is a $20 million hit right off the top. They call these incremental investments. I call it the real messy cost of integration starting to hit the books. Second, they're blaming the weather. Severe storms are expected to cause a $20 million direct impact. Now, that's an external factor, sure, but it also highlights just how fragile a complex logistics model can be. And third, and this might be the most important one, higher Dasher costs. They mention seasonality, but they also mention investments in system capacity and rising costs in regulated markets. This points directly to rising labor costs and the constant expensive battle to keep their delivery network running smoothly. These are not trivial headwinds. But this is the number that really gets my attention. This is the one that should make any serious investor pause. The cash flow. Because at the end of the day, profit is an opinion, but cash is a fact. In the fourth quarter of 2024, DoorDash generated $420 million in free cash flow. Solid. Now fast forward a year. After all that massive growth in revenue and all that GAAP profit we just saw, what happened to their free cash flow? It declined by 40%. It dropped to just $254 million. That, my friends, is a massive red flag. Where is all the cash going? If your profits are soaring but your cash flow is plummeting this dramatically, it forces you to question the actual quality of those earnings. And right here, we start to find some of the answers. This chart shows the year-over-year growth rate of their key expense lines compared to their revenue growth. So revenue, in blue, grew at that strong 38% clip. But look at the other bars. Research and development, up 41%. And look at general and administrative costs, up a whopping 48%. When your core operating expenses are growing significantly faster than your revenue, it suggests that the cost of maintaining and growing the business is actually escalating. You're having to spend more and more just to get that next dollar of growth. That is a crack in the very foundation of operational efficiency. It's the exact opposite of the leverage story the bulls want to tell. Those are all valid points. There's no denying them. The guidance is weak, and that cash flow number is a serious concern. But this is where you have to zoom out. You have to step back from looking at a single 90-day period and look at the long-term blueprint. Management would argue, and they are arguing, that these rising costs and this cash burn, they aren't signs of weakness. They are calculated, strategic investments in building a much larger, more dominant, more defensible empire. This isn't about milking profits today. This is about pouring the concrete for total market dominance tomorrow. So let's look at how they plan to do this. On the earnings call, CEO Tony Xu laid out 3 core missions that really explain their entire strategy. First, expand beyond just restaurants into adjacent local commerce. We're talking grocery, retail, convenience. This is a massive, massive expansion of their total addressable market. Second, they want to build the omni-channel software for merchants, things like their storefront product for websites or 7 rooms for reservations and seating. This isn't about just being a delivery app anymore. It's about becoming the essential digital operating system for every single local business. And third, connect all of that on a global scale. That's the grand vision. But achieving that global vision requires solving a huge technical problem first. Right now, they're actually operating on 3 completely separate technology platforms. You've got the original DoorDash in the US, you have Wolt in Europe, and now you have Deliveroo in the UK. The plan is to consolidate all 3 of these into one single, unified, global tech stack. Now, this is an enormous and incredibly expensive undertaking. It explains a lot of that R&D spending the skeptic just pointed out. But think about the payoff. Massive improvements in efficiency, the ability to innovate faster, and to roll out new features to the entire world in an instant. They're paying a heavy price now for a much more powerful and efficient machine down the road. And that same investment thesis applies directly to those new categories, like grocery and retail. This slide basically lays out the entire roadmap. In the first half of 2025, they were in heavy investment mode, no question. But look what happened by the second half. The unit economics were already improving quarter over quarter. Then in Q4, these new verticals attracted more new consumers to the platform than any quarter before. And here is the key milestone. They are telling investors they expect these new businesses to become economic profit positive in the second half of 2026. So yes, they are burning cash on this right now, but they've laid out a clear time-bound path to profitability. This isn't just throwing money at the wall, it's patient, strategic capital allocation. But the boldest part of their entire blueprint is what they're building for the deep future. Just listen to this quote from CEO Tony Xu. He's talking about autonomous vehicles, or AVs. But he says the real value isn't just the robot car itself. He says, perhaps the most valuable part is our autonomous delivery platform. The software, the brain that can match vehicles to routes, that can manage the complex handoffs between a self-driving car and a human dasher. This is the heavy, heavy lifting required to fundamentally change the entire cost structure of delivery forever. And this slide right here visualizes that vision perfectly. It's not about replacing all the dashers tomorrow. It's about creating a mixed fleet. Imagine an autonomous vehicle handling the long, simple part of a delivery down a main avenue, and then a human dasher handles the incredibly complex final 100 feet to the customer's apartment door. By building this autonomous delivery platform, they want to optimize every single delivery for maximum cost savings and speed. This is their moonshot. It's a massive, long-term bet that could make them truly untouchable if they pull it off, and it justifies every single dollar of that R&D spending we're seeing today. Okay, so we've laid out both sides of the coin. You have the bull case, a powerful, profitable growth machine making smart, strategic acquisitions for the future, and you have the bear case, weak forward guidance, seriously declining cash flow, and escalating costs that can't be ignored. The blueprint for the future is ambitious, absolutely, but the short-term stress fractures are very real. So let's bring it all together and deliver the iron financial verdict. Is DoorDash an opportunity to buy into a future king, or is it a trap for investors who are ignoring some very clear warning signs? Let's put it all on the scales. On one side, you have the heavy steel beams of the bull case. Explosive, undeniable growth in GOV and revenue. An accelerating order volume that seems to defy the law of large numbers. Strong and, more importantly, growing GAAP profitability, and an aggressive expansion strategy headlined by the immediately accretive Deliveroo deal, all tied together with a clear, ambitious long-term vision. But on the other side of the scale, you can't ignore the stress fractures of the bear case. The Q1 guidance is undeniably weak and signals a sequential decline in profitability. That 40% year-over-year drop in free cash flow is a major concern about the quality of these earnings. Key operating expenses are rising faster than revenue, which calls their efficiency at scale into question. And finally, the enormous cost of integrating all these acquisitions and funding these long-term moonshots is draining real capital from the business today.
So, we're left with the one final crucial question. Is DoorDash a fortress of growth, with some temporary scaffolding and construction costs that are just obscuring its true underlying strength? Or is it a house of cards, where that impressive top-line growth is just masking a fundamentally weak and costly foundation? The verdict from Iron Financial is this: DoorDash is a classic battleground stock, and the right answer comes down entirely to your time horizon. If you are focused on the next 1 or 2 quarters, the weak guidance, the cash flow pressure, and those rising costs present a significant trap. The headwinds are real, and they could easily weigh this stock down. However, if you are a long-term investor, someone who believes in that blueprint, in the shift to an all-encompassing local commerce operating system, in the global platform unification, and especially in that moonshot bet on autonomous delivery, then these short-term pains are simply the necessary investments required to build an unbreachable fortress. The question you have to ask yourself is this: are you willing to endure the noise and mess of construction for a potential stake in an empire? That's the choice, and how you answer it will determine if DoorDash is a generational opportunity or a dangerous trap for your portfolio.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.